Lifetime Capital Gains Exemption. How Canadian business owners can take advantage when selling their business. If you're a Canadian small business owner, farmer, or even involved in a fishing business, today's topic is one you definitely want to understand. The Lifetime Capital Gains Exemption, or LCGE for short. This is a huge tax planning opportunity that could save you and your family hundreds of thousands of dollars when it's time to sell your business. So today, we're going to break down what is the LCGE, what counts as a qualified small business corporation share, the tests you need to meet to qualify, and strategies to ensure eligibility, and whether you can use it more than once, what crystallization and purification mean, and the most common mistakes we see. Welcome to the channel. My name is Anthony Gismondi. I'm a senior wealth advisor with Aegis Wealth Management, a part of Wellington-Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. What is the LCGE? The Lifetime Capital Gains Exemption is a tax incentive for Canadian residents. As of 2025, it allows you to exempt up to $1.25 million in capital gains from tax when you sell qualified small business corporation shares or qualified farm or fishing property. Here's the catch. If you are selling your business, it only applies if you're selling shares of your small business corporation, not if you're selling the assets of the company. That structure matters, and that's why good planning well in advance of a sale is critical. What is a qualified small business corporation? For your company to qualify, it has to be a Canadian-controlled private corporation, or CCPC, and the shares you're selling must be what's called qualified small business corporation shares, or QSBC shares. These are shares in a private Canadian-owned company where you or someone related to you own the shares for at least 24 months. More than 50% of the value is from assets of the company used principally in an active business carried on primarily in Canada over the 24 preceding months. And all or substantially all the assets of the company are used in an active business carried on primarily in Canada at that given time. That means no passive investment companies that just collect rent or dividends. We're talking about real operating businesses, retail, trades, manufacturing, professional services, businesses that actually do something. Strategies to qualify. If you're not sure your business qualifies or might not qualify in the future, there are a few strategies we often recommend. One is purification. This means you clean out non-business assets, things like excess cash, passive investments, or real estate that aren't part of the active business. The goal is to make sure most of the assets are used in active business activities. Number two, don't forget farms and fishing businesses. Qualified farm or fishing property, like land, shares, or licenses, can also be eligible. And just like small businesses, these need to be owned for at least 24 months and used in an active business. Keep in mind, there are differences between the tests for farm properties, those for qualified small business corporation. Can you use it more than once? The LCGE is a lifetime limit, not a one-time use. So yes, you can use it multiple times across different businesses or property sales until you hit that $1.25 million cap. For example, if you used $500,000 back in 2007 when the limit was lower, you'd still have another $750,000 of exemption available today. Crystallization and purification. Let's touch on two important tactics we mentioned. Crystallization is when you trigger a capital gain on purpose through a reorganization or estate freeze in order to lock in the LCGE now, even if you're not planning to sell soon. This gives you peace of mind in case rules change or your business no longer qualifies in the future. Purification, again, is all about removing passive assets from the company to maintain eligibility. Both require careful planning especially with a tax advisor, to avoid costly mistakes. Common mistakes to avoid. We see a few common pitfalls with the LCGE. Waiting too long to plan. Many owners only start looking into this a few months before a sale, which is often too late. Not monitoring or purifying. If your company builds up too many passive assets, you could lose the entire exemption. And perhaps the biggest one is not getting professional advice early. So, the Lifetime Capital Gains Exemption can be a powerful tax planning tool, but only if you structure things properly, start early, and avoid the common mistakes. This is one of those areas where having a good tax professional and wealth advisor by your side is critical. Every situation is different, and the stakes are high. If you're a business owner or thinking about selling, succession, or retirement, let's have a conversation. We can help you structure things right and preserve more of your hard-earned wealth. Thanks for watching, and don't forget to like, subscribe, and share this with a fellow entrepreneur who should know about this.